IAS 33 earning per share. Before we move forward, one needs to understand hello. One needs to understand that EPS is a ratio. EPS is a ratio, right? So when we say EPS is a ratio, what is meant by ratio? And for the benefit of everybody, I will simplify it as much as possible. So here is my whiteboard and notepad. Any figures can be represented in 4 types. Okay. Amount, percentage, date, and ratio. So we must understand the connotation of EPS, and connotation of EPS is ratio. It is neither an amount, neither a percentage, nor a date. Unless we understand this, we cannot imagine the connotation of the same. What is ratio? The biggest interesting part about ratio is that ratio can be seen only in comparison with same or similar situations. So for example, if the EPS of one company is 99 and another company is 5, then somebody will feel that first company is doing very well. But if you say that one is pharmaceutical and another is engineering, then they may not be comparable. Similarly, one company's EPS is 412 and another company's EPS is 1000, then we cannot say that the second company is doing very well or first company is doing bad, because size of the both the organization may be totally different. One may be Reliance Industries, another may be ABC Private Limited, having a small trading business. Then, so you will have to look at the closest competitors to compare. And the second way to compare is the period. That is like saying that the previous year, okay, or the past few years compare with, or compare quarter wise, etc. etc. Right. So having said that, earning per share is a ratio, important to note. Then why there is accounting standard for it? Because it requires financial reporting. It is the compulsory part of profit and loss account, compulsory part of SOPL. Now, apart from this, the IAS 33 lays down that the earning per share calculation methods. So So for that purpose, while calculating the ratio, we must know what is earning and what is share. We also should know what is the purpose of this ratio. One, of course, it is compulsory to show it as a part of P&L at the end. But why it has been made compulsory? It is a decision-making tool for the shareholders or investors or prospective investors to make an investment decision, whether to invest more or newly invest or get out of investment, etc. It's an investor's decision-making tool. Having said that, we will discuss the scope of EPS. So have a reading of this. All right. I give you 2 minutes to read this slide. Right. So I hope you have read this slide, and thus we can say that IAS 33 earning per share is required to be presented for two types of companies, that is separate as well as consolidated. Now, whose ordinary shares or potentially ordinary shares are traded in public market. What do we mean by this? We are meaning by this that the share market, as you all know, if it is being traded on that, then whether domestic or foreign, but the EPS must be presented. Similarly, what we know as something called as prospectus. So if an entity files or in the process of filing, so they're planning to have the financial statements filing with the securities control. It's like they are coming up in the public market or they are coming up with IPO. Then EPS should be presented both in separate financial statement as well as consolidated. So having said this, what does it mean? For example, A Limited, its shares are being traded publicly, and there is B Limited, which is its subsidiary. So under IFRS, three financial statements will be prepared. One, A Limited separate. Two, A Limited consolidated. And three, B Limited separate. The EPS to be shown will be one here, and one here. But EPS of separate A will not be shown in consolidated. Neither EPS of B. All right. Then let us look at what is basic EPS. Basic EPS formula is given here. Profit or loss attributable to ordinary equity holders of the parent entity. So we are talking about parent entity because in the consolidated accounts, the profit share of group company is going into non-controlling interest in the respect of subsidiaries, and it goes into only the own share of profit in case of associate and joint venture. Many times when we ask a question, what is the numerator of this ratio? You get an answer called PAT. Honestly, PAT is a wrong answer because the preference shares dividend are adjusted after PAT because the preference shares dividend are sort of a expenditure which under new IFRS standard is shown as interest expense. However, though they are shown as interest expense, they are disallowed for tax. So therefore, we should have the adjustment of preference dividend. Because after tax amounts many times are on the profits which are before tax and without deducting dividends of preference share. Similarly, during the year, if the preference shares are settled and there is some extra cost paid, then that also should be reduced because that is not available to the equity shareholders. Third parties, in some cases, the preference shares may get classified as equity. Which are those types? For example, compulsorily convertible preference shares or perpetual preference shares or preference shares which are irredeemable. Now, we are studying the global financial reporting standards. So, we should be aware that the instruments like perpetual preference shares or perpetual irredeemable preference shares or compulsorily convertible preference shares or part of optionally convertible preference shares also falls under equity. And in such cases, any dividend impact or settlement of preference shares impact is needed to be adjusted after PAT. PAT means profit after tax, right? Up to here, I'm taking the people to ask me questions on chat mode, right? Anybody wants to ask questions in chat mode, please write. You have 2 minutes to write any questions in the chat mode so that I can respond them, check up whether everybody has grasped everything, whatever is explained so far, so that moving forward will make sense. Yeah. Type here, please. Amit Singh, we are yet to come to denominator. Okay. As regards perpetual criteria is concerned, perpetual means two types. One is they are redeemable, they are irredeemable, or redeemable only during liquidation. Right? So I'm repeating the answer. Perpetual means they are either irredeemable or redeemable only during liquidation. I repeat, for the benefit of everybody, I repeat, perpetual preference shares one can be irredeemable. A question was asked on this in the previous exam. Or redeemable only in liquidation, or redeemable at the option of company. Is the answer clear to Bhavin Jani? Now, since our course is very practical oriented, I will take you one step further and show you the balance sheet of Tata Power. Tata Power 1819 balance sheet is opened here, and I am showing you the Ind AS balance sheet of Tata Power. You can check similar balance sheet for Tata Steel also. You can read here what is stated: unsecured perpetual securities. So, for example, if I give a search on the word perpetual, then here are the notes to accounts. And we can come back and see how the things are being considered. Yes. Can you see here the Ind AS balance sheet which shows equity and liabilities? And under equity share capital, the second item is unsecured perpetual securities. So whether they are debentures or preference shares, they are falling under the title equity. This is how we teach you the practical balance sheet cases studies, and therefore you will be able to do the IFRS implementations and even Ind AS implementation by doing this course. And liabilities are shown separately. Right? So, can you see Tata Power balance sheet and have understood it? And if you go next, the notes are saying so have a look at the notes to accounts. What does it say? The notes are callable only at the option of the company. Can you see this? Are callable only at the option of the company. So even they are coming under equity. Please confirm that you are clear. Please say yes if you are clear as to what goes under equity title. So even though that may not be equity share capital, the case is that Lalit Ajmera, please ask specific point which you want me to repeat. Because I have explained the point over 15 minutes. So whichever part you are not very clear, please explain me. I am saying in short that a perpetual preference share or any security in the nature of perpetual will be classified under other components of equity if it is irredeemable or redeemable only under liquidation or redeemable at the option of company. And if the profit after tax does not consider the dividend on such kind of instruments, then that should be deducted from PAT because that is not available to equity shareholders while calculating the numerator for the purpose of EPS. So it could be unsecured perpetual securities can be debentures as well as preference shares. Are you all clear? Can I go ahead? Because there are nitty-gritties. The questions were asked on irredeemable preference shares in the past exams. All right. Now we come to the denominator. The denominator is talking about weighted average number of shares, that is share outstanding during the period. So if I am calculating the number of shares outstanding, then I need to know that what is the number of shares on each of the day or each of the month, and accordingly I should work on calculation of denominator. So in this connection, I will give you one example. Okay, one example which you should solve it. Okay, which you should solve it. So are you ready with pen and paper to solve the example? Then we can discuss it. So be ready with pen and paper. Example, A Limited in its SOFP. SOFP means statement of financial position, like balance sheet. What we say, has 10,000 shares into bracket equity as on 31/3/21. This is after buyback of 3,000 shares on 1/11/20 and fresh issue of 5,000 on 1st June. Calculate denominator of EPS. I'm giving you 5 minutes for you to solve this question correctly. Use months, not the days, and calculate weighted average number of equity share for the year 1st April 20 to 31st March 21. You have 5 minutes. Yes, I'm waiting for your answers in the chat mode. This is a simple weighted average calculation. Right, only 2 people have replied. So anyway, let me calculate. April and May, June, July, August, September, October, November, December, January, February, March. So the number of shares in March were 10,000 for the month of March. February also were 10,000. January were also 10,000. December and November were also 10,000. So 10,000, 10,000, 10,000, 10,000, 10. All right. So 10,000 into 5, 50,000. Then we are referring to buyback of 3,000. So prior to buyback, they must be 13,000. 13,000 for October, September, August, July, and June. 5 months. 13,000 up to 13,000 into 5, 65,000. And there was a fresh issue of 5,000 on 1st June. So before the fresh issue, they must be 8,000. 8,000 into 2, 16,000. Are you okay? Have you understood the calculation? So the total calculation is 1,31,000 divided by 12. So 12, 12 के 12, 12 शून्य शून्य, पूरे अष्टों से शेषपूर्ण around this much. Okay. Let me do on the calculator so that there is no issue. A minor mistake is fine if it is done via calculator. 1,31,000 divided by 12. This is 6.66. So 10,917, and very good for the people who have done it correctly, and those who are done not correctly, please check my working, and if you have any query, please ask in a minute's time. You have 1 minute. We are saying that Amit Singh, thank you for correct answer. Moti is correct answer. Lalit is correct answer. Anybody else has a query on this? Any query on my workings? Please ask urgently. Yeah. And this is how you all should be able to do quick calculations. Exam is not very difficult, but you should be ready to answer very quickly. Any query on my workings? I'm waiting for your saying that you are all clear. Clear, yes or no? Please reply. All right. So everybody is clear. Now we are going ahead. So you'll have to learn to respond fast. Okay. So here it says number of days, you can do number of months also. All right. So we go to the next thing. So here is an example. 5,000 shares were issued, 10,000 were for 9 months, and therefore we calculated the weighted average number of shares. What are the adjustment to the weighted average number of shares? Now this is the most critical part of this standard. Ordinary shares can change because of bonus shares, or they can change due to consolidation of shares, or they can change due to stock splits. Similarly, there can be discounted shares, for example, rights issue. If the shares are issued at a discounted price, that is called as a bonus element in rights issue. Now here, the bonus adjustment does not change any resources. Company doesn't get any additional money or reduced by any addition. And therefore, the change in the number of shares without change in the resources. Such a case, the impact on EPS will not reflect the picture correctly. And hence, in order to make the ratio comparable, the previous year's figures will also be adjusted. Therefore, one should learn from this that number of shares at different denomination can make the ratio uncomparable. Right. Let me take through one logical set of things. So here is the previous year of the company and here is the current year of the company. Number of equity shares and PAT, or let's say PAT minus dividend or profit available to equity shareholders. Numerator and denominator. Numerator was 100 crores and denominator was 10 crores. Current year numerator was 120 crores, denominator was 10 crores. Situation 1. Bonus issue happened in the current year. Thereby, the number of shares became 10 plus 10, right from the day one. So the ratio was originally 10 and 12, but due to bonus shares, it became 10 and 6. So we say that, look, the performance has gone down. Is that true? No. So we need to adjust retrospectively. Now they are comparable, 5 versus 6. Situation 2. The 10 crore shares were having the face value of 10. So 100 crore was the equity share capital. But we decided that we will make face value from 10 to 1. Therefore, the number of shares became 100 crore. So my ratio was 10, but now it becomes 1.2. Poor performance gone down. Is that correct? No. Because no transfer of resources in this case, And therefore, we have to look into the situation where the face value has been brought down. It means split. So in case of split also, we need a retrospective effect. So 100 divided by 100 is equal to 1, and 1 has become 1.2. So this calculation would be incorrect. Let's take a third scenario. The 10 face value 100. So the number 10 crore became 1 crore. 100 divided by 10, last year was 10 as a ratio. Now the ratio is 120 divided by 1 crore. Let us celebrate, our EPS has gone up. The performance is zooming up. Wrong conclusion. Consolidation of face value leading to increase in number of shares means 100 has become 120. Right? So it's not zooming up performance. It's very normal. So are we clear? I hope we are clear on what is the reason for giving retrospective effect in case of bonus issue, in case of stock splits, and in case of consolidation. However, in case of bonus element, in rights issues or options or warrants which are below market price, we need to learn how to calculate it. In fact, I will say the most critical part of this standard, or the part of the standard where one can definitely go wrong, or that part of the standard which can ensure that if you have understood that part, then you are bound to succeed, is nothing but this part. This part. If you understood this, be guaranteed you will do everything correctly. Okay? Because the rest of the things are very simple. Right. So how to give the adjustment for bonus element? Now in this case, what we need to do is, we need to calculate what is known as theoretical X right price. And then the face value per share immediately, fair value per share immediately before the exercise. Fair value is market value. So we need to have theoretical X right price calculated by market cap as on that date, plus proceeds from exercise of right, and divided by the new number of shares. Right. So here I am giving you one example as to how to calculate it. Understand carefully. A company had 400 million shares right from the beginning of the year. Okay. And halfway through, they issued 100 million, that is 4:1 right shares. The share price was $5. And this rights issue was at $4. So 400 into 5 is equal to 2000, and 100 into 4 is 400. So totally 2400 divided by 500, that gives you a theoretical X right price of $4.8. This is called theoretical X-right price. Now, phi is the fair value or market price divided by 4.8. This is the multiplier to be used to calculate the first 6 months and the previous year's retrospective effect. So for the full year effect, I will increase the shares 400 into 5 divided by 4.8. Is that clear? So please grasp this working, and we are now taking a small tea break. So be ready after 15 minutes. It is 11:30. I'll be sharp back by 11:45.